Today we will get to the last part of topic 8, which deals with something called closing entries. On the screen, you see the problem you had yesterday. The XYZ company had a number of entries, a number of transactions that were journalized and then posted. So that was done for you. What you had to do was to take account balances and put them on these financial statements. So you took, hopefully, you went to the sales account, found that in sales there were 2 credits adding up to $20,960, and you put that amount of money into your income statement. So income statement shows revenue and expenses. Same way with the 3 expenses. When you go to those accounts, you put in the proper amounts of money shown in the ledger, and that adds up to $32,415. When you subtract, you have a net loss, and that was indicated by the note at the bottom. This is a little unusual. XYZ company for the month of May lost money. Then you were to do the balance sheet. Again, you had to go to these accounts. If you looked at cash, there were a number of debits and credits in the ledger. If you add up the debits, add up the credits, you need to subtract the credits from the debits, and you end up with a new balance. So at the end of the month, cash has a debit balance of $57,030. If we looked at the cash at the beginning, at the end of April, we had $89,730 in cash. When you add up the debits and subtract the credits, we have now a little bit less than that. We have $57,030. Accounts receivable, inventory, we found that by using cost of goods sold, and hopefully you'll understand that whole process. And that's the inventory, which accounts for the amount of inventory we purchased, and then also accounts for the inventory that we sold, the cost of goods sold. In topic 8, we talked about depreciation. We bought office equipment, and the accumulated depreciation in this company is done monthly because they have a monthly accounting cycle, and that's a $25 minus. And this is shown on the balance sheet because often people want to see not only how much we paid for the asset, but how much it has declined in value. So this is shown. Next month, this would be minus $50 because it accumulates. So total assets add up then to $100,140. Total liabilities, we went to those liability accounts, added them up, total there. And as I said in the note down below, the owner's equity account back in the ledger is not up to date. This amount of money, $62,125, is as of April 30th. We don't have nothing in here for May. That's what we're going to be doing today. So you had to use the accounting equation. If you took total liabilities, subtracted it from total assets, you get $50,670, and that balances the balance sheet. Now, today we're going to talk about this number because we need to have that verified in the books of the ledger so that the owner's equity account is accurate in the ledger. Right now it is not. So we go back to the journal. We will do 3 closing entries. A closing entry means that we will look at revenue and we will look at expenses and we will close them, which means the accounts will end up with a 0 balance. So this is always done at the end of the accounting period. The first entry will be an entry to close sales. And I get $20,960. And I get that from the revenue account. $20,960 is the total. So what I'm doing here is debiting, as you just saw in the journal, $20,960 comes from journal page 5. This is account 401. So we take it back to the journal, account number 401. So that closes sales. We had a credit of sales and now we debited sales. So sales now has a 0 balance. But you know in accounting, every entry has to have a debit part, which we have, also has to have a credit part. Now, we will use a new account called Income Summary. that's what gets credited. This is a very temporary account used only for this purpose, income summary. We find it in this section, and I told you yesterday I would explain this later, and that's what we'll be doing right now. So we just looked at the journal, which said it had a credit of $20,960. Okay, journal page 5. So the money was basically taken out of revenue and put into this temporary account, account number 302. Back in the journal, account number 302. Okay. And this is our explanation. The second closing entry will be to expenses. Now, expenses have a debit balance, so to close them, we need a credit. So this time we will debit income summary, that new temporary account, and we'll figure out the amount here in a second. And we will debit each of the expenses that we have. The first one is depreciation expense for computers. And if we go to that expense account, we see computers has a debit balance of $25. So to close it, we need a credit of $25. So let's post that. We'll go to the expenses. And we will credit 25. Journal page 5. This is account 501. Back into the journal 501. So that expense account's been closed. Second one that we had is salaries. And that will also be closed, I believe, by $15,000. If we go to the expense part of the ledger, we see salaries expense is debited by $15,000. So if we want to close it, we need to credit $15,000. So now it has a zero balance. So two expense accounts now have been closed. And that's account 502. And the last one is the cost of goods sold. And that, I believe, is $17,390. And if we go to the expense section, we find it here. And it does have a debit balance that we figured out earlier in an earlier problem that is a debit balance. So to close it, we credit our J5 again and account 503. There we go. 503. So these three expenses, and a business may have many more, but this company has three, all had debit balances. To close, to make them have zero balances, we need to credit each of them by their balances. And when I add up those three, I have to have a corresponding debit that equals that. And that comes to $32,415. So now one debit and three credits in the same entry equal. So this time I need to go to the income summary and debit this time. By $32,415. And journal page 5, and this is account 302. So this has the effect of closing all the expenses. So we've had one entry to close the revenue account, one entry that will close the expense accounts, and now the third entry is to close the account we just started to use. We need to close income summary. Now, when you go to income summary, you'll see that the debit is higher than the credit. The difference between the two, if you subtract, is a debit balance of $11,455. So right now, this income summary account has a debit balance of $11,455. To close it, I need a credit of $11,455. So back in the journal, let's start with our credit actually here. Income summary has to be credited this time by $11,455. And if we go to that account, and we credit by $11,455, put our J5 in here, or journal page 5, we have two credits that will add up to $32,415. So this has the same amount on both sides, so income summary is now closed. Now we finally get to the point where we use the owner's equity account, because in this last entry, owner's equity is used. And it has to be debited because we've already had a credit in this entry. So it's got to be debited by $11,455. Okay, we didn't put our account number in here. So if we go to owner's equity, now we finally put something into this account from J5, and it was a debit of $11,455. This is unusual because this company lost money. If it would have made money, that last entry would have debited income summary and credited owner's equity. But we had to credit income summary in order to make it balance out and close. So that meant if this is credited in income summary, the debit must be to owner's equity. This balance now, well, let's put our number back into the journal and finish this part of it. So we've closed income summary. So we open it up and close it the same day. But let's go back to our owner's equity. And now we started at the end of April anyway, we started with $62,000. We lost money, so the difference between the $62,125 and $11,455 should be $50,670 if you subtract one debit from the credit. That will give you a balance of $50,670, and if we did it right, it will equal the same amount we did back in our balance sheet when we subtracted liabilities from assets. But we verified it now with closing entries, so now there's a paper trail, if you will, in the ledger showing how we got to that net loss in owner's equity. So at the end of May, the owner's equity is less than it was at the end of April. As always, you can go back and review this video because the three closing entries are very important ones at the end of the accounting cycle, and they're always very similar. The difference would be in that last closing entry with a company that made money, these two accounts, owner's equity and income summary, would be reversed. We would end up with a debit with income summary to close it, and we would end up with a credit to owner's equity, which would increase the value of the business. So at this time, go back to your course page, please.